want to sell the news alerts. These are all my personal trades that I give to you daily. I want to review a step-by-step of what you'll be able to anticipate when you sign up for this alert service. First, you'll want to come here, select the upgrade, then automatically STN alerts will be upgraded to your selection profile. From there, when you click on it, the bottom alert will be the newest alert. Then you can scroll up to see all the other alerts. No matter what day you start your service, I would highly recommend going back and looking at some of these alerts. Some may still be good to enter into the trade, but here's the trade setup. You'll have first your ticker, and you can see this alert came at around 8:30 in the morning, New York time. Next, we give you the option expiration date, followed by which call to sell, and then which call to buy, hence the plus or minus sign. After that, we give you the STO, sell to open, and GTC, good till cancel, at $2.50. This is a limit order. After you're filled, you'll put in BTC, buy to close, and GTC, good till cancel, at $1.25, giving you 50% return on your money. Next, we give you a picture. This is based off our Thinkorswim account, so your brokerage might look a little bit different as far as the layout. Here you can see on June 9th, 2021 at 8:30 a.m. in the morning, we talked about Clove. And when Clove opened up in the morning, we were able to enter into the trade right here and got this huge sell-off. This represents our break even. GameStop, same day, just before the open, June 9th, 9:30 a.m. We got in right here and huge sell-off. Here's another one on June 9th, TIGR, just before 11 o'clock, June 9th, 1:30 p.m. Got into the trade, started to go the right direction, but then went totally against us for 5 days before falling back off. Then there's other trades like Wish that we're still waiting for to come back up into our entry zone to get us into the trade. And that's why we use good till cancel. Because some trades might take a minute, an hour, a day, or even a couple weeks. Potentially, you're going to have a lot of trades. Some you're going to be waiting to enter. Some will give you back quick returns. Some might take 30 days until they give you back all of your returns. And some we're going to lose. We're trying to do a hands-off approach for you so that you can do the other things that you need to in life and still let the market work for you. Every trade we're going to do will be a bear call spread. Sometimes this is called a bear call credit spread or vertical spread. We're using this because we're expecting a decline in the price of the underlying stock. We're selling calls to bring in premium and time decay, at the same time purchasing calls for protection. So let's take an example from our alerts. NMM, we gave around 9:20 a.m. You're not going to be able to read this, but it was $180 risk to $320 reward, and the break-even price was $28.20. We said do a bear call spread on the month of July. Sell the 25 calls, buy the 30 calls. So what does that look like? We sold the 25 calls down here. We bought the 30 calls up here, giving us a spread between the two. As we said before, the break even is $28.20, so price just had to come below this line here. We're up $1,300, 40%. Just after 5 days, that's not bad. Now we're going to take profits off at 50%. So we're always going to give you that 50% target. And that's because we're doing a 1-to-1 ratio. $100 risk, $100 reward. The reason we're closing out the trade at 50% profit is because that $100 risk to $100 reward drastically changes. At that point in time, it's a $150 risk to a $50 reward. And I don't like to risk $150 to make $50, so I'm going to take the trade off. But you can trade how you want. Like GameStop gave 88%, Cliffs gave 81%, while Clover gave 94%. Or if you're a little bit more conservative and you want that quicker money, you can make your target less at 20-25% profit, exit out of the trade. GTC, good till cancel. We view this strategy as a win-to-loss ratio. We have a high probability of win, and so when we're in a losing situation, there's a couple things you can do. You can either roll out a month, you can roll up a strike price, or you can exit the trade early. That's up to you. For us, the way that we're going to trade it is we're going to do a double down approach, hence the 1%. So if you placed 1% onto the trade and you're losing and we're able to place another trade on the same ticker, then we will do a doubling down approach. So if our first trade was a $100 risk to $100 reward, our second double down approach would be $200 risk to $200 reward. That way, when our second trade, which has even higher probability that it's going to work out, it will make up for the first $100 that we lost, and then we'll get $100 for this trade. Double whammy. And here's why I don't change my trades like on T. For 26 days, it went totally against me. Then it dropped below my break even, giving giving me all my profit. And I find that more times than not, if I don't change the trade, get fancy with things, get in fear and try to readjust and just let it work out, it works out. But I'm not perfect. AMC, I called it right here. Blast off to the moon. I lost out on this trade, but I re-entered here, doubled down. I was able to make enough profit to get back my first trade that I lost on and the profit from up here, doubled down. The great thing about credit spreads is you can get in pretty cheap. Most of the trades you'll see will be $50 to $500 for one option contract. It's up to you to scale to that 1% of your total portfolio. But again, this is a repeatable thing. It's the same exact trade. There's no hype. It's very consistent. We're not trying to sell you on trade alerts so that we can take your money to make money. All the proceeds are going to charity. Last month, we gave $5,000 to our local food bank. I wish you the best of luck in your trading.